The star of the week, again, it's kind of like a quasi star of the week, is Converge Technology Solutions. But really, despite the stock's recent jump up 52%, the company really isn't much of a star and more of a dog, as we have covered the company several times on the podcast and have always given it, essentially a poor review, given the company's low margins, growing debt load, and growing share count, leading us to believe that despite its low valuations, from time to time, they did get elevated for a bit. But the stock was, essentially a value trap in our opinion. So Converge Technology Solutions, CTS on the TSX, currently trading at a price of $5.40 with a market cap of about $1 billion and a dividend yield of about 1.1%. So they are a software-enabled IT and cloud solutions value-added reseller. They focus on delivering advanced analytics, application modernization, cloud, cybersecurity, digital infrastructure, etc. So, like I said, I have covered Converge several times on the podcast now. The first time was in October of 2020. The second time was in March of 2022. And the third time was in May of 2023. And again, every time my conclusion was essentially along the lines of the business having great growth, top line growth driven by acquisitions, which was funded by both debt and equity dilution. But the stock had very thin margins, which made it difficult to justify the stock gaining a substantial EBITDA or price to cash flow multiple. And the last time I discussed the stock in May of 2023, management had just concluded a strategic review process to evaluate a full range of alternatives, but decided to continue as a public company and execute on its business plan. One of those alternatives were, trying to actually just sell the business itself, but they decided to continue just operating. However, a year and a half after this strategic review, the stock is up due to HIG Capital announcing that it would acquire Converge in an all-cash transaction and take it private, where shareholders will receive $5.50 per share in cash, which values Converge at an enterprise value of approximately $1.3 billion and an enterprise value to adjusted EBITDA multiple of about 7.4 times. The transaction will be subject to court and regulatory approvals and clearances, and the transaction is expected to be completed during the second quarter of 2025. And once completed, Converge's stock will be delisted from the TSX. So just a few takeaways after following Converge for the past several years here. So again, revenue growth was tremendous, driven by an aggressive cadence of acquisitions, which were funded by debt and equity. A much harder growth strategy to execute on compared to, just a pure organic growth story. Now, the company has always traded with quite low valuation multiples, except for when it got to, 22 times EBITDA at its peak there, or enterprise value to EBITDA. But adjusted EBITDA margins just continued to be very thin. Debt has been high. And again, share issuances were a common occurrence, making us believe the stock was in fact a value trap. They ended up implementing a dividend, which in our opinion, it would have been better off rather than paying out that dividend to just pay down debt, essentially. Now, back in 2020, I highlighted that several of Converge's executives were originally from the publicly traded company Pivot Technology Solutions, or PTG, on the TSX. And like that of Converge, management rapidly grew top-line revenue through a growth by acquisition strategy funded by debt, but management was never able to generate accretive EPS growth, which I warned may repeat with Converge, and is essentially kind of what we saw. So despite me listing the stock as our star of the week, given its recent takeover announcement and jump in share price, the company's fundamentals were, just never really to our liking.
In terms of Converge, I will note they also released their preliminary Q4 results just on Monday, I believe.
And
gross sales were up 2.2%. Revenues up, I guess, 4.6% in the quarter. Adjusted EBITDA an increase of 3%. And there was a loss of $21.2 million in the quarter. So the business, there's not a ton of growth. What we saw initially, just this company went out, issued a ton of shares, made a ton of acquisitions, built up. They had a net cash position, built up a ton of debt, and then just started selling off assets because it's for us. Low margin business, don't like the way it grew. Promised higher margins, really never got there. And I mean, in the IT services segment, we were able to just midway through this year buy a company that has 15 to 20% EBITDA margins, and that stock in about 6 months is up 160%. So,
Yep.
like, there are other small cap related companies in Canada that you can buy, and the growth in this company, it is profitable and on EPS basis that I'm talking about, and a far higher growth rate, better margins, and the gains even with this takeover are far higher in that company. And if there wasn't a takeover bid here, which I would question who is buying them, I gotta say, to be honest, with the margins that they've had and the lack of growth there. But even with those gains, like, the gains would be far better with the company we're talking about. And that's what we're looking for. Just a business that's growing top line. And we're talking about organic growth in that
Yep.
business versus the only growth in this business really was by acquisition. And we prefer organic growth, just a better way to run a company, and just not issuing shares constantly, going into high debt, and then selling off assets to pay off debt. I mean, it doesn't make a lot of sense. And that's why really you've seen, I mean, this stock reached highs of $11, $12, and now it gets bought out at five somethings.